Here we will walk through a question related to the purchase of equipment with non-interest bearing debt. Yummy Food Limited has been experiencing increased customer demand for its specialty food products. To meet this demand, the company has bought additional refrigeration units to hold more inventory. To finance this purchase, Yummy Food issued a 4-year non-interest bearing note with a face value of $400,000. The prevailing interest rate for similar instruments is 10%. The company agreed to repay the note in 4 equal installments. Yummy Food used the effective interest method to amortize any premium or discount. And the first thing that we're asked to do is record the journal entry at the date of purchase. Okay, so let's think about this. We've got a company that has purchased refrigerations. So in exchange for the refrigeration units, they issued a non-interest bearing note. So it's a 4-year. Just turn on my pen here. So it's a 4-year non-interest bearing note. And remember, whenever it says non-interest bearing, it actually does bear interest. It's just a way of referring to the note that doesn't explicitly pay interest. There's no actual interest payments. And it has a face value of $400,000. The market rate is 10%, and it's going to be repaid. This is really important. It's going to be repaid in 4 equal installments. And we haven't seen any installment notes. And we're also told that they're going to use the effective interest method. So how are we going to record the note on our statement of financial position when the note is issued? So we know that we always record notes payable at the present value of the future cash flows. But we weren't told what the present value is. We're told the face value is $400,000, but it's not at par. It's a 4-year non-interest bearing note, which is not the same. So we need to calculate the present value. So let's get out our financial calculators and figure out what we're going to put. So we know that the market rate is 10%. So we know we've got 10% as our I. That one's pretty clear. We've got our N is going to be 4 years. Got that up there. And the payment on this note is going to be the payment. So it's interesting. So there's no explicit interest payment, but it's being repaid in 4 equal installments. So in theory, if we take $400,000 and divide it by 4 payments, there's going to be a $100,000 payment as an outflow. And the future value of the note is going to be 0, because when the note matures, unlike most notes where we have to repay the face value, because this is going to be repaid in 4 equal installments, we don't have anything that we owe at maturity. We just owe $100,000 a year, which we've recorded as the payment. And so that gives us everything we need to put in present value. So let's put that into our financial calculator and click compute present value, and let's see what we get. So the present value that you should have gotten is $316,986.54, which we're going to round to $316,987. Okay, so now we know that this is the present value of this $400,000 note. And so we are going to record, the journal entry that we're going to record is going to be definitely credit notes payable. For $316,987. But what's the debit? So normally we would have debit cash, because when we would issue a bond or a note payable, we'd be getting cash. But this company issued the notes payable in exchange for the refrigeration units. So our debit is actually going to be to equipment, or you could call it refrigeration unit or what have you, but it's some sort of an asset. So that's another difference that we're seeing in this question, that we're actually exchanging it for an asset, not for cash. But the principle of recording it at the present value is still the same. Okay, so now we've done A, and B says, prepare the journal entries at the end of the first year to record the payment and interest. Okay, so how are we going to do that? So the first year, to record the payment and interest, we're going to have Now, it's important that we look at this question. We're going to see they want us to do the end of the first year and the end of the second year. And we're told that it's going to be the effective interest method up here. So the best way to make sure that we've got the effective interest method correctly is to set up our effective interest method table. So let's set up that table. So we've got the year. We're going to have the payment. And we're going to have, so sorry, this is usually the cash payment. This is usually the interest expense. This is and then this is going to be the amortization of a discount or a premium. And then this is going to be the carrying value. So this holds true. It's just going to be a little bit different when we do an installment note. So we know that our carrying value on year 1 or year 0 and then 1 and 2, because this is the date of acquisition. Our carrying value started at $316,987, right? Sorry, my 8s look so weird. $316,987. And we know that we're going to have, at least for these years, it's actually a 4-year note, but we're only doing 2 years because we were asked for the journal entries for 2 years in the question. So we know we're going to have a payment of $100,000 each year because we're going to pay 4 payments of $100,000 each, to get to the $400,000 face value. Now the question is, what's the interest expense on that payment? And the interest expense is going to be the carrying value, just like we would normally have, the carrying value times the market rate. So it's going to be $316,987 times 10%, which is the market rate. So that's going to give us an interest expense of $31,699. And then we don't have an amortization of a discount or a premium here. Well, I suppose the difference actually here, should be the difference, the 100,000 minus the 31,699. This actually is the difference, 68,301. And that's how it normally is. It's the difference between the cash payment and the cash payment minus the interest expense gives us the amortization of the discount or the premium. So therefore, our new carrying value of this note is going to be $248,686. You can see normally we would be increasing this value of the note to the 400,000 because at the end of the life of the note, we would need the note on our statement of financial position at $400,000. Why? Because normally when the note matured, we would owe the entire face value back to the investor. However, this is different because we're paying the investor down over the 4 years. So our note needs to actually be at 0 at the end of the 4-year term. So it's decreasing each period. So then year 2, we've got 100,000 as our payment because it's our installment payment that we were told. So therefore, $248,686, the carrying value, times the 10% market rate is going to give us $24,869. And the difference between the 100,000 and the 24,869 is going to give us 75,131. So 248,686, the carrying value minus 75,131 is going to give us 173,555. And if you continue this through to the 4th year, you would get to a 0 face value. So that's what our effective interest schedule looks like. Just going to change my color here to try to make things a bit more clear. Okay, so that gives us our payments. Now all we need to do is record our 2 journal entries. So we're going to have our journal entry, December 31st, 2020. And we are going to have debit. So this is this year here. So we're going to have debit interest expense because the interest expense is going to go through our income statement as an expense. And we're going to take this number here, 31,699. Then what are we going to do with the note? We're going to increase it by this amount, which is what we're increasing the carrying value by. So we're going to go So we're decreasing the value of the note because we need it on our statement of financial position at 0 at the end of the term. So notes payable, which you can clearly see the carrying value is reducing. So this is going to be 68,301. And the credit is going to be to cash because we are going to pay out this $100,000 payment. So that's our journal entry for December 31st, 2020. And then our journal entry for year 2, which is December 31st, 2021. It's going to be the same thing, which is our year 2 here. We're going to have debit interest expense, which is going to be this number, 24,869. We're going to have debit note payable because we're reducing the note payable balance, which is, of course, a liability. So debiting it is reducing the balance. So this is going to be the reduction here, 75,131. And remember, we got that number because we took the difference between the cash payment and the interest expense. And the interest expense is how we always calculate it, which is the carrying value of the note times the market rate of interest. And then our credit is going to be to cash, and it's going to be the $100,000 again, because we are going to pay out 4 payments of that $100,000. So hopefully that makes sense. We haven't seen a note where it was an installment note payable before. And so the difference there is that rather than at maturity, rather than paying back the face value, we've actually already paid it back. So it should be at 0 because we don't owe anything at maturity. So that is how an installment note payable looks. So I think if we go up to the question, we finished the year 1 entries and we finished the year 2 entries. So we've worked our way through this question.